Well, here we are, folks, a special Monday evening show, the penultimate live stream from this studio, and welcome to you all. Nice to see a lot of familiar names on the chat there. We've built quite a community over the last few years, and I hope that we'll be able to preserve that community as I move on to my new location, dial down the shows for a little while I relocate, but then fire them up again. And rest assured, I'm still going to cover Australia, still going to do the same sorts of things, and hopefully get quite a few of the guests that I've had on previously to come on again. The time difference actually works in my favour. It's just a morning show in the UK, isn't an evening show here, so it's not like it's impossible. Of course, the doggies are here as well, and they're sound asleep. They don't like the very hot weather today. We had 36 degrees here today, the hottest in 2 years, so it is very, very, very hot even now. So they've been quite curled up and quiet in the aircon here. I turned the aircon on, so the piano's probably going to tune, but I couldn't survive without the aircon today. Anyway, without that further ado, I think we'll get on with the main show, because there's plenty to talk about. Tony's teed up ready to come in, and there's a lot to explore. I call this show, making sure we see things right. We need to actually understand what's really going on. And of course, Tony's great with his truth bombs and his also his Locantro bingo. So we'll be playing a bit of that tonight. So let me start the intro. I'll be back with the main show in just one moment. Well, good evening and welcome to this live stream on the 6th of March 2023. Martin North from Digital Finance Analytics here. Great to have you on for this special Monday evening show, and thanks for taking some additional time out of your week to spend it with me in the community here. It's greatly appreciated. Before I bring Tony in, let me just remind you, of course, as I always do, we don't provide specific financial or legal advice. It's a general conversation only. We do moderate the chat, so please be a bit mindful of that. This is at the 6th of March if you're watching in replay, and I encourage you to ask a question tonight. If you would like to ask a question, use @WalkTheWorld to get to my attention or to ask a question. I've also enabled Super Chat, so if you'd like to make a contribution to what we do here, greatly appreciate it, or indeed get your question to the top of the list, you can use Super Chat to do that. Right, I'm going to push this button and hopefully Tony will appear. Hi, Tony.
Hey, Martin, and hello to this wonderful DFA community. I came in and had a little bit on the chat, but most of the time I like to stay hidden in the chat. I'll let Cookie direct things. And just for those on the chat, my 14-year-old son is going to watch this through his attention span, which will be about 5 minutes.
That long. That's pretty good.
Yeah. Not bad for a TikTok generation.
I was going to say, is he doing something else on another device at the same time? Because what I find fascinating is the ability, it's seemingly to be able to do 3 or 4 things at once. I'm not sure whether that time slicing really works, but it appears to be quite interesting.
Yeah, well, big shout out to Lockie if you're still watching. But, geez, Martin, what an interesting time to be alive. And more recently, I've been doing just quite an amount of self-reflection. And I guess that comes from yesterday I went to visit my mum in a dementia ward. And if you ever want the motivation to get off your ass and do stuff, I think a dementia ward is an ideal place to visit. And, yeah, it's really sad. And what happened, I actually went to the Sting concert and I was thinking, wow, look what life deals you. This guy in his early 70s, he's as shredded as steel oats. Unbelievable, still with it. It was an amazing concert. And then I look at the cruelty of a dementia ward. And what I said to my kids is, I don't want to give you long essays. I don't want to give you lots of advice, but start lifting weights and then everything else will fall into place. So pretty much that's going to be my message to my kids. We can deal with the stock market building wealth later. But the sad thing about this generation, guys, is that they're all TikTok affirmation generation. And it's going to be hard for someone on social media to become the next Warren Buffett, I guess. And the other point of self-reflection, I actually went and saw the movie After Sun. Mixed reviews, some loved it, some hated it, but it really packed an emotional punch. It made me get back to the relationships from their own kids and cheap package holidays. So lots of self-reflection. And I guess it culminated in watching 60 Minutes last night. And I just don't think cooked, rooted, or Cookie's favourite word, wrecked, are strong enough to describe where we are in Australia. And to be perfectly honest, Martin and the audience, we're absolutely fucked.
Yeah, well, it's certainly concerning to see all of the worrying signs that you and I have been talking about for a number of years, actually. If you go back over 4 or 5 years, we've had a number of conversations. But it's always about the fact that there seems to be a one-sided set of arguments that, that unlimited debt's fine and people can actually, survive it, and interest rates will stay low and property prices will always go up and stock markets will always do well. And, it's like that there's this sort of nirvana that people believe is actually happening. And then reality is starting to dawn, right? And I said a few years ago, as long as interest rates stay low, it'll be fine. But remember, folks, interest rates don't always stay low, right? And in fact, you and I know, Tony, that the long-term mortgage interest rate in Australia is between 6 and 7%. And that is a shocking number, given the amount of leverage we've got in the system at the moment, given how many people with so much debt. And what I worry about is the unequal distribution of that debt. And, we have a number of people doing reasonably well and, income fine and, they've got low mortgages or no mortgages, but you've got a huge chunk of the population that's leveraged to the eyeballs, and you've got another huge chunk of the population that's in the rental sector and is seeing their rents going massively up. And when you put that in the round and then think about some of the international contexts, you've got to say that we are in a very, very uncomfortable patch. And anybody who is convinced that property prices are bottomed and they're going to rise and interest rates are going to drop in the next few months, I think they're living in cloud cuckoo land, frankly, Tony.
I absolutely couldn't agree anymore. And they're going to go back and blame Lowe. But I remember his words, and he said it could be plausible that rates won't increase. He didn't say they won't. He said it's plausible that they may not. So whether or not we're going to have Slater and Gordon send more suits after him, but surely the bond market was telling us otherwise. And who would have gone out and borrowed a shitload of money on the provision that rates would start to go up in 2024? And what really scares me is that you're right about the long-term RBA cash rate. It's between 6 and 6.5, maybe 7. Long-term mortgage rates, 9% is the norm. Now, what scares me, well, it'll probably scare everyone, is that the average mortgage in New South Wales, let's just say they got one of those honeymoon fixed rates, their interest bill is going from $16,000 per annum to $56,000 a year. How the hell is that family that have already been beaten up mentally going to find an extra $40,000 post-tax or a $60,000, as I said, $60,000 per annum job? And now we've got Nurses and Midwives Association telling nurses they can't go on OnlyFans because they're high profile. So what are they going to do? Ban them from delivering pizzas? And what I think, you just cannot find that income, because I know what it's like to be under financial stress. I'm in a job now. When I was a cop, I had an average pay. I knew how to live. But my income's relative to the small cap market. Right now, the small cap market is the worst I've seen it in 8 years. So throughout my career, it's 5 steps forward, 3 steps back. Normally it's a divorce that gets you. I've had a couple of divorces. I hope my son's not on here still, but that's what gets you. But I mean, this is serious, really serious. And I don't know that, financial stress is like having a background throbbing headache, and you're not present. You're not present with your kids. You can do what I did. I made a big boo-boo of buying sizzle steak. I might as well bought used tyres for the family. That was an embarrassment to have sizzle steak cooked perfectly because it was atrocious. And I promised my family, look, I'll buy Scotch fillet, which has now got a security seal on it from Woolworths. And I was saying to Juliana that we're going to see not the welfare generation wheel in a trolley and take all the meat. We're going to have working families now which will pull a balaclava and go in and steal their groceries. I just cannot emphasise enough how much of the shit we're actually in. And I looked at the ASX forecast of rates. I looked out to August 24 and they're still 3.9 and change. So, you know, it's like a 40-degree night, no aircon, you've got humidity, and all you can do is turn your pillow over on multiple times. There's no relief coming at all. The best time to sell your used car was, I know Tarek put up the used car index. There was a peak there in used cars. Too late to sell your treadmill, your chest freezer. The best garage sales have already happened. I just don't know where it's going to come from, Martin. And the sad part is we're looking at between 800,000 and 900,000 mortgages about to hit that mortgage cliff. And interest rates, their interest payments are about to triple. So we're in a world of pain, and I think it's only going to get worse.
Yeah, absolutely. Well, there was a report today that suggested more people were having to take extra jobs, you know, second and third jobs to try and actually bring a bit more income in, because that was the only way that people could make ends meet. And I guess, Tony, you and I have spoken a number of times about the societal impacts when people get into financial pressure. It isn't just a financial problem, right? It's a social problem, it's a societal problem, and it leads to a whole bunch of other consequences, you know, from violence and other things too. And it's that social degradation that I'm really concerned about, because I think that people are going to find it really, really tough to find a way through this. And it's just worth reflecting. The RBA, of course, is responsible for listing interest rates, and they've said quite, frequently and recently, rates have to go higher because inflation's too high. Inflation is sticky; it's not coming down. The last number was higher rather than lower, and all of the indicators are it's going to stay high for some time. So the RBA is pulling its interest rate levers, but of course it can conveniently not look too far beyond that. But what I'm doing in my surveys, and what other people are doing now, is calling it out in terms of the consequences. So Roy Morgan's come out and said 1.35 million people in mortgage stress. NAB published a survey over the weekend, 4 in 10 households in significant difficulty. And my own mortgage stress numbers, which are actually higher now than they've been. This is actually, I'll go through this in more detail tomorrow on my live stream because I've got all the latest data, but we've now got 46.7% of mortgage holders in mortgage stress, and the rental stress number, 61.86% of those renting, is horrendous. I mean, these are numbers that I never want to see, because there are so many consequences and implications of this. And I think it's also worth underscoring, Tony, that the government's view, of course, is that they've got very high debt, lots of deficits, and interest rates are rising, so the cost of debt's rising. So it's not like they can magically pull another load of money out of the air like they did through COVID without significant further consequences. So wherever you look, socially, economically, politically, I just see roadblocks.
Yeah, and inflation's like trying to remove dog poo with a stick. That's honestly, that's how bad it is. It's not going away. It's entrenched. We're not going to see any major relief at all. And the scary part is that we've seen a moderation in the falls. We've had a little uptick. Tarek explained that beautifully, that it's the ego-driven properties, the top echelon, that have increased 5%. So suddenly I've seen charts saying that the inner west, the falls have subsided. When I was a police officer in Redfern, the locals were so kind that they'd throw you a VB and a brick at the same time. And it's amazing that these suburbs suddenly become blue chip. I remember surfing at Curl in the late 80s, early 90s, that area was rough. Then suddenly it becomes blue chip and everyone wants to live in North Curl. So things are certainly changing, and it's just got totally out of kilter. Obviously I grew up on the Northern Beaches, so I look at the prices in Narrabeen, French's Forest. I mean, yeah, volumes are so low that I just think this is the calm before the storm. And heaven help us once volume starts to increase. And those two magic words for a real estate agent, as I keep saying, it's not Anacott Steel, it's called price discovery. And we haven't had a lot of forced sales yet, but suddenly a real estate agent can take evidence of lower sales in your suburb or in your street, and they're going to say, look, you're going to have to sell it for this. As you said earlier, anyone that thinks that the falls are over is delusional, because you can't have that sort of increase and only give 10 to 15% back. You have to, as per what Morgan Kelly said, Morgan Kelly he had that online debate, TV debate with Jim Power. Morgan said Irish house price is going to halve. Jim Power said no. Morgan's extensive research on OECD housing bubbles said you give up 70% of the gain. So let's just say the market goes from 1 million to 2 million. You keep 300,000 of that gain, and that's frightening, and it hasn't even started yet. And I know that mortgagees, those with mortgages, are starting to get the letters. And the other worrying aspect is that on 60 Minutes, they said, well, just over 3 million people have a mortgage, but 1/3 of that market is investors, and the investors are leaving the station. But the investors really haven't panicked yet. And those without a mortgage might say, well, you beauty, I get 5-6% on my savings. Well, you're going to get walloped on the value of your property. So this is going to affect everyone, unfortunately, and there's no way to avoid it. And I've been saying for a while, adopt the brace position. Well, guess what? This shit now is real.
Yes, and of course there was an opportunity to make some tactical decisions, earlier on. I actually think we're quite close to the end of the runway now. It's quite difficult to know what to do. I mean, give you an example. I sold my property, a little while ago, because I could see that property prices in this area, so in Thurrool, which is north of Wollongong, the median house price got above 2.2 million. And I could see it was coming back, so it got down to 1.6 million, and it's dropped even further now. So I made a decision to get out before prices dropped too far, because I could see where it was going. Now, I was lucky because I was able to do that, and I had the flexibility to do it, and I was able to find somebody who felt that was actually a reasonable price to pay, so we actually did a deal. But you have to be quite agile to be able to actually make those decisions rationally when the market's sort of sloshing around all over the place. And so many people said to me, well, just sit on it for a couple of years and then property prices will be back up to 2.2 million again. I don't believe it. The thing to understand is the property prices were inflated by ultra low interest rates, ultra free lending, and all the government handouts, home builder and everything else. It was completely artificial, and it was actually done in a way that I think was frankly irresponsible, because the real value of property is not where property got to, and we are not yet back at, I think, fair value for property. I still think we've got further to go to come back to a sort of a more rational, realistic level. And it's worth noting that many borrowers are still at 6, 7, 8 times income. I mean, that is not sustainable, particularly with the interest rates we've now got. So navigating this is really difficult. And then, of course, you've got the stock markets, which have been up and down like a bit of a yo-yo. And, of course, January was seen as quite a strong month, but that was artificial. And then February's been a weak month. And now we're looking, well, is it going to go up, down, sideways? And what's the Fed going to do? I mean, so the financial markets are also in a degree of undress as well. And, of course, then we've got the broader issues, the economic issues. The China saying 5% growth is probably as good as we're going to get. Well, that's an amazingly low number for China, and that's going to have a significant impact more broadly as well. So pretty much wherever you look, all of the elements are in flux at the moment. And I've been around for a reasonable length of time. I don't recall a time when so many of the elements are all sloshing around in a sort of an uncontrolled way, and then you've got the political class basically blah blah blahing on the top and not really taking it too seriously. This is pretty horrendous, and I don't think I've seen it as bad as it now is.
No, certainly not. And the way I look at it is it's been a once in a generation opportunity to really address it as stupid money and take a lotto win tax-free. So that's the scenario, because we had, admittedly, Liberals fluked that election. They were expected to lose. And then suddenly we had COVID, where banks threw money to borrow a house for a house at 1.99%, and the market went stupid. And it made me look stupid because in hindsight, I lost the bet with the kook. That was $2,500 I won't get back. But that bubble was out of control. And that happens at the end of every speculative bubble. I go back to the dot-com bubble. That was a once-in-a-generation opportunity to make a lot of money and take it. And every speculative bubble along the lines has been the same. And I even go back to some of the earlier bubbles in the early 2000s. And the problem with a speculative bubble is that it's hard to see it coming. And when you're in one, you don't realise you're in one. You think this is the norm. And I can tell you, markets are a great leveller. It's a bit like, I don't know, diarrhea is a great leveller because it gets even the filthy rich. It gets the billionaires. If they eat something dodgy, then they can obviously take an Imodium. But I think investors, sadly, are going to need that. And from my own experience, I've had lots of lotto tickets in my career over a long period. I've sold a lot of stocks too early, and some of them I've been taught an absolute lesson, and regret weighs on you. So if you've got financial stress, there's a lot of breadwinners out there, mainly men, who are going to feel like a failure in the eyes of their family. And then we're going to have the wife or partner or saying, why didn't you tell us to sell the house when prices were that high? And then suddenly you've got that regret loop. And then you've got the financial stress loop. And then suddenly you've got the bank saying, well, where are your repayments? It's just really, it's tough. And that extends to every market, because if you have a look at, I sent you through a chart, Martin, of margin lending.
Let's put it up.
Yeah.
There you go.
Now that chart is frightening. So that shows the take up of margin lending just before the market got poleaxed. And I was broking at the time. We had margin lenders offering trips to Hawaii for those that sold the most loans. And that was an absolute collapse in margin lending. We ran into the GFC. The ASX 200 pretty much got cut in half. So margin lending was the fuel for that bubble. And during those times, we had the misguided belief, well, the word on the street was that self-managed super fund inflows would support blue chip valuations. Just go to your favourite castle saying on that one. Now, what keeps debt-fueled speculative bubbles going is debt. And now families and borrowers now have far reduced capacity to borrow. Now we've got the 3% buffer, so that's scary in itself. But what happens to every speculative bubble in history is that once sentiment levels out and becomes negative, crash helmets at the ready. Because I've noticed it in every commodity ending in IUM, gold, silver, uranium, retractable syringes. God, there was a childcare bubble, a egg bubble, an agricultural bubble. It's just bubble. But once the sentiment subsides, it's all over. And I remember auctions in the paper, the Daily Telegraph, bulletproof suburbs. ridiculous prices of properties in Leichhardt without a car space. And there was FOMO. It was FOMO driven and similar to consumerism at the top of the BN buy now, pay later bubble. But I think what this period is going to teach people is, I've always said, we're going back to the 70s when life was more simple. We had less items, higher quality, but there's just going to be the mother of all resets. But before that happens, because this debt's got to go somewhere. And yeah, no, it's as ugly as it gets. And I wish there were levers that could be pulled, but we've got to tame inflation. And unfortunately, for the RBA, that's precedent. So it just doesn't get any uglier.
No, absolutely. And just on the borrowing power thing, it's really interesting because a lot of people don't get the borrowing power issue. So there's two factors to it, right? The first is that there is a margin above the current mortgage rate, it's 3%. And APRA came out the other day saying, no, we're not going to drop that because we think that there's risks in the system and those risks are potentially going to grow higher ahead. So what that means is that because interest rates have gone up from very low levels to typical mortgage rate of 5 or maybe even 6% now, that means that they're actually assessing the borrowing capacity on 3% above that, so maybe 7, 8, 9%, which means that the average borrowing power for a new borrower today is about 40% below where it was before it started. So that's the first factor. The second factor is the HEM, the household expenditure measure, which is effectively how they think about debt servicing. And of course, the debt servicing is looking at the income and expenditure. The expenditure is based on a set of ratios, driven ultimately from the ABS through the Melbourne Institute. And the HEM is also now taking account of the higher inflation and the lifting costs. So as well as the borrowing power problem with interest rates, you've got the HEM problem with serviceability. And you put those two together, and Tony, what I'm seeing is that people are able to borrow significantly less now than what they could. And if you go back a couple of years when people were actually borrowing to the hilt, when interest rates were ultra low, those ratios I mentioned earlier on, those people are out the money now. There's no way that they can afford the discretionary income to be able to actually cover those additional costs now. And you mentioned the cliff. The cliff, of course, is going to happen. July is going to be the peak month, I think, but it's going to work through this year. And there's no chance that interest rates are going to drop lower later in the year, and so provide a get out of a jail card. So then you have to say, well, so are we going to see intervention? Is the government going to do a sort of a COVID type response? And is APRA going to give the banks ability to be able to extend the life of a mortgage? And we're going to see some of that. But my problem, Tony, is that the quantum of the problem we've now got, the amount of exposure, is you can't actually adjust your way out of this. You got to actually go through the pain, and that's the real problem that I see ahead. I don't see a way out other than to see those defaults rise and to see people really going through hell for a period of time. And it pains me to say it, but I have seen it before. I've seen falls in the UK 3 times, in fact. One triggered by tax changes, others triggered by interest rate changes, and a couple of other things. And it takes between 5 and 8 years for the market to sort of adjust and correct and begin to take off again. So anybody who thinks that this is a short-term problem, in a few months we'll be out of it, they're on the wrong planet. This is going to take years to sort out.
And I guess now, once you're under that sort of pressure, you've got to then look at, is my job safe, and are my full-time hours safe as well? So talk about just an absolute shitstorm of factors that are contributing to this. You might see some school teachers or nurses think, well, they can set up their own side hustle, but it's very tough to set up a side hustle. And if you're going to do something out there, you got to be friggin' first. I mean, we had that guy that sold 1 million pixels. Remember that? He sold 1 million pixels for $1. We had that guy that exchanged a paperclip for Bonnie Doon. we had the early Married at First Sight stars that got onto OnlyFans and have killed it. You've got all these YouTubers, that kid that opens toys and reviews them, he makes a gazillion. But if you're going to do something like that, you have to be first to do it, and you've got to have the mental energy to say, well, I can do this. I can set up a cafe that's going to make money. If I set up a cafe, it'd be instant coffee and Vegemite on toast. But I look at, it's terrible. I mean, who'd want to own a friggin' restaurant, for God's sakes? I don't know. It actually hurts when I go to my local shopping centre and I see a restaurant in a place that has gone broke 5 times and the new owners think something's going to be different.
Yep.
And there's just going to be so much pressure now to find these side hustles, but it's not easy. You know, who's going to want to iron shirts in their spare time or do gardening? And I mean, you've got to look at it honestly. My partner was in aged care. It virtually killed her. She hasn't worked in aged care for a year, but there's plenty of jobs in aged care. And I can see that the demographic shift in aged care will change because there's opportunities to get into that industry. They've just been given a handy pay rise. So, you know, the thing about Australians is this might sound out of kilter or a bit, I don't know, observational, that Australians have to do the jobs that they don't want to do. They won't have a freaking choice because you've got all these people that come out here that work hard, they work multiple jobs, trying to build a better life. And, there's going to be fierce competition now. So, it's pretty messy, but what can you do? You've got a generation that's trying to make money on social media. There's just not that income around. And what I've learned, I'm 51 now. I just think consumerism is the biggest load of shit there is, to be honest. You've got to get your dopamine hit, going out and spending money. I mean, you've got to look at what you're spending on. I think buying, I've bought new cars in my time, but I think now those out there are going to think, well, why the hell do I need a new car? Just get a steering wheel protector or get a new paint job. You don't need to upgrade your TVs all the time. Go buy a Tommy Hilfiger polo that will last you 5 years instead of 20 polos that won't. It's just, consumerism is fun till it isn't. And I think we're going to go back to that 70s style of living where we don't own as much. And it's just, as I've mentioned before, Martin, there's just going to be a massive washout in the system. But what I've said here now is, quit your streaming service, watch it for a while, then rejoin, binge. There's going to be smart ways of doing that. I looked at KO, $35 a month. I mean, that's just ridiculous. So,
well, I'll tell you something, Tony, because one of the things I do in my surveys is to understand how households are actually thinking about their spending patterns, right? And it's interesting asking them what they think their priority spending categories actually are. And I'll tell you, and that surprised me, that your mobile phone connectivity and your streaming services, in more than half of the households I surveyed, they put that in the must-have category. It's very interesting. And, that's in the same category as, I need to buy food and clothes, etc., and pay the mortgage. So it's not seen as discretionary. So in a way, my feeling is that many people have effectively been sucking on the marketing company's Kool-Aid and have now a sort of a philosophical mindset as to what a normal spending pattern actually is. But it's a lot of frippery.
Yeah, it certainly doesn't make you happy. And I started on dry January. I'm continuing. We're in March. I haven't had a drop of alcohol all year. So, and I've joined the gym. I'm at the gym 5 days a week, and I guess my 3 S's for happiness now are sex, steak, and squats. So I've had to make that adjustment. But it's awesome to go out and not have the alcohol bill at the end of the night to drive. We went for this beautiful degustation a few weeks ago. But I tell you what, lemon lime bitters doesn't pair too well with wild boar. So anyway, there's a hint for everyone.
Yeah, very good. And Jason quite rightly said, internet's an essential service, streaming isn't. I agree with that. And that's really what fascinated me about the fact, and how many streaming services do people have? Well, in my surveys, 3 seems to be average. So some people have way more and some people have a bit less. But, do you really need 3 to 5 streaming services at, whatever it is a month? It's interesting. It's a very interesting philosophical point about how much is too much. And then the other interesting observation, and I don't know whether you've seen this, Tony, too, is that people have changed their shopping behaviour. So they are going to deep discounters like Aldi. They're spending less. They're buying different quality of items. And of course, Coles and Woolies, who actually reported their results, they observed the different spending patterns. And I think that's going to be very interesting to see how that plays out, because will people make sensible decisions, or will they make not sensible trade-offs in terms of what they buy? And in the UK, for example, we know that over there, because the cost of fresh fruit and vegetables have gone through the roof and supply chains have been disrupted, there are now groups of households whose quality of food has actually been dropping because of the economic consequences. And of course, that has long-term health implications too. So, like I said, all of these things are not just financial, they're actually connected to lifestyle and social and all those things. And I really worry that we don't understand some of the implications that will follow from some of these decisions.
Well, actually, I've got a bit of a tip. I won one of those dinner box delivery services. I won a free box. And what I've found is that if you get these boxes, it's like HelloFresh, Every Plate, Marley Spoon. They'll give you about up to 65% off, and then you can quit any time. So you keep moving around. If you quit one, then they'll say, we want you back. And that has really kept us away from the shops. And the food quality has been good, and you don't have to go through these decisions to cook meals. And it's worked a treat. So anyway, there's a little bit of a tip that have a look at HelloFresh. HelloFresh is probably the best out there, but you're not at Woolworths buying a handful of cherry ripes at $1 or grain waves when they're discounted, or Smith's chips. It just keeps you away from spending. And what I've found is that there's 2 of us in this house full time, that we can get a box of food for $70, 5 meals. So it's $14 a meal. Viewers are probably thinking, it's tight-ass Tuesday with me, but I don't need to overspend. It's markets sometimes can hand you one, but, my phone calls, I'm going to be honest, are down probably 80%. And that's reflecting a very flat emerging company market. And that's just the way it is. I've been here before, and I think, well, how can I keep away from the shops? And what it does, it makes you eat healthy as well. And that's why I said to my kids, look, to start lifting weights and everything else will fall into place. So I just think we need to make those lifestyle changes, and we need to be mentally strong for what's ahead, because you don't want to be in the fetal position and ignoring the private number calls which come in, which are the bank, the ATO, or heaven help you, the child support agency.
Yeah.
So that's my suggestion. And if that's the only thing you take away tonight, viewers, then so be it.
Now let's move the conversation on slightly, because of course the financial markets have been in turmoil since the start of the year, and I'll be interested to get your take on the bull versus bear conversations, because there were so many people in the market at the start of the year saying it's going to be a great year, we're going to see a massive run up, and then it went quite well at the start of the year. And then we hit February and the Fed said, no, we're going to put rates up higher. And then people started getting twitchy about where the terminal rate's going to be. And basically the markets came down. And then in the last few days, the market said, I don't think the Fed's really going to go that high. And so they're sort of going up again. But it seems to me that the markets are deceiving themselves at the moment. What do you think?
Interesting. question, Martin, because the S&P 500, which is actually 505 stocks, fell a bit over 19% last year. And you've got commentators saying, well, it's not going to fall again. It's very hard to read. The Dow Jones index, which scares everyone, just seems to be dancing sideways as well. The ASX 200 is pretty much at record high territory as well. So, and what I noted is that on Twitter, there was widespread calls for the mother of all crashes, and the market went the other way. So I see huge headwinds in the bank stocks. Commonwealth Bank obviously broke down, but they're still going to pay decent yields, so that sector will be insulated somewhat. But if you have a company that comes out with something slightly negative, they get poleaxed. Yep. It was like Invocare, which does the funerals and cremations. I mean, it's one of the sure things in life. And they said, well, it's tough. So they got absolutely walloped. So where do you hide? You might have said, well, I'll look at Star Entertainment, casinos. And then suddenly they get fined and the share price collapses. It is really tough at the moment. We've had lots of speculative bubbles on the exchange. Lithium, this EV theme that seems to be going forever. Rare earths just got poleaxed because Tesla said we're not going to use rare earths in our batteries anymore. So that high-flying sector has been walloped. The view I take in the market is I look at M&A activity and I look at gold producers. The Australian gold price is over $2,700 an ounce. In US, it's $1,852. The thing, I like gold producers, but you do have production risks in those gold producers. I think silver, I know people have been saying this for years, I think silver is the most undervalued precious metal / commodity there is. It's around $21 an ounce. And I actually remember the days when Warren Buffett was selling his silver for about $4.25 an ounce, and there was absolute pandemonium when Kodak said we're going to digital photography. And there was the belief that silver wasn't going to be used in photography. So silver went through a tough period, but I just think that gold and silver are the two areas where you can build decent holdings. I also am looking at the uranium sector. The uranium price is about $50 a pound. Uranium in 2007, I think it touched about $143 US a pound. And the commentary is saying it needs to be $60, $70, $80 to encourage new production. Some of the experts on uranium are suggesting 2023 could be a year of transformation. So I know that viewers are more focused on property, the economy, and there's not many out there prepared to take a risk. But at some point, if gold can continue to rise into these headwinds, the gold producers suddenly become large dividend payers as well. So, yeah, look at tech stocks have had a bit of a rebound as well. But overall, the indices have held up remarkably well. But, the stock market always looks ahead. Most of the factors in a share price are baked into the price unless they come out with a shock announcement. Whereas if you look at property, none of this negativity is baked in yet. So, look, I'll keep persisting with what I do. The small cap stocks that have gone from 10, 20 million caps to $1 billion with liquidity have held on quite well. The stocks I'm involved in with low liquidity have wide market depths and are prone to the odd capitulation. And I think to an extent that could be reflected in other markets, including property. So, yeah, this is a really tough time all round. And I don't think there's anywhere to hide at the moment unless you time a short position well and you build a holding that captures the downside, Martin. But, yeah, market's very hard to read. And it only takes a little bit of negativity to see the downtrend accelerate.
Yeah, very interesting. And what's your take on the on bonds? I'm thinking particularly the long US. A number of people like Harry Dent, for example, says in the current environment the only thing to go for is basically the long-term treasuries, because pretty much anything else is just too risky. I guess the question there is, well, are they going to default on their debt ceiling or not? And is there going to be consequences? But the bond yields are, if I look at the 30-year US at the moment, which I can just put up, they went all the way up to over 4. They're down now to 3 and a bit, 3.8, and the 10-year is also it's sitting around 3.9 at the moment. It went above 4. Bonds very differently behaving from where they were, some time ago. So what's your take on the bond story?
I think obviously Harry makes a lot of calls. I think his greatest call was the demographic cliff. So look, I certainly think that there might be a lot more interest in bonds, longer term treasuries, as you say, as well. So I don't see any reason not to be involved in that sector. Obviously, with less risk, you might even look at hybrids. But I think at the moment, if you're looking at some of these term deposit rates for savers, they're looking mighty attractive as well.
Well, I have to tell you, I shouldn't boast about it, but I saw a 4.95% last November, right? And I thought that's a very good rate. I'm going to have some of that. It's a 5-year, right? So I've taken a punt that 4.95% over 5 years is going to be a reasonable return, and everything that I'm seeing at the moment suggests to me that's not a bad call. So we'll see. Yeah,
I guess with what's happening is we saw savers on 60 Minutes last night. The guy with his boat, he's getting a great rate of return. A lot of bank accounts were getting bugger all, and I don't want to harp on it, but let's see what happens with that $3 million superannuation slug as well. What is the wealthy 0.5% of the population going to do in that regard? So, and I mean, that's a whole nother show, guys, on tax and what's going on there. But look, if you like, steady as she goes, maybe do have some bonds, some cash. Obviously, what I've found is the economy and markets, it's a bit like one of those 2.5 day pitches in India. And my way of treating that pitch is by aggression, adopting Travis Head, come out, belt the ball, just keep swinging rather than go defensive. So that's my mindset. But no doubt that we've got a lot of investors, a lot of the country, they're going to be absolutely spooked with what we're seeing now with that sentiment shift. So unfortunately, I'm going to look back in 2 years' time and think, wow, I could buy these wonderful companies at such discount prices. But when you've got such opportunity, it's the darkest of times financially. Most investors are fully invested, and it's a lonely place at the bottom. And God, heaven help us what the bottom of the property market's going to be like. Maybe it's going to take... I think there was a headline that said the death of equities. Maybe it's going to take a headline, the death of property, for the bottom to be in. So, as I said, it's like playing one of those pitches in India that spins from the first ball. It's really tough, and a lot of the population aren't financially literate. They wouldn't understand, sadly, what a price to income ratio, what all the requirements with borrowing and long-term interest rates. Ask someone that just bought in at the peak what the long-term interest rate is. I think it's going to take a major calamity to see financial literacy rates lift and to have people have an honest discussion about what is actually happening with their money, because you can't keep your head in the sand and you just can't keep avoiding those private numbers and the letters in the mail, because it ain't going to go away.
No, I think that's an interesting observation. The general level of knowledge and awareness, I've been trying in my little way to try and help raise some of that awareness in recent times. But, a lot of people, of course, who are Australians are forced savers because they have the superannuation system, right? And it's an interesting observation that many superannuation funds are reporting considerably lower returns this year. And of course, they're still taking quite a lot of fees. So I think quite a few people are going to be quite surprised when they see their next superannuation statement as to how much value they haven't got. And bearing in mind, of course, we also had quite a few people a couple of years ago taking a lot of money out of superannuation as through COVID was facilitated by the government. So superannuation is also something to think about. And again, I worry that many people have a set and forget mentality and say, well, presumably somebody's doing the right thing. There's no real, great assumption that necessarily it's in the right place and doing the right thing, because, look at a portfolio of superannuation performance. There are some stronger, some weaker, but a lot of people, I think, could be quite shocked there as well. So it's like there's no safe haven, there's nowhere to hide in this, whether it's property, whether it's superannuation, whether it's shares or whatever. I mean, the risk levels are just off the scale, really, and that's why I tend to be a bit more conservative at the moment and say, well, if I see an opportunity, then I'll go for it. But I've played it pretty conservative the last little while, and okay, I might have missed some of the upside, but it's partly about asset protection, and I think that's the other point I wanted to make, Tony. There is a philosophy that says I want to make my portfolio grow and get bigger, but there's also an equally important strategy about asset protection, and I wonder whether we have a sufficiently strong conversation about asset protection and whether that's something people should be thinking about.
Oh, absolutely. And the other major risk with these superannuation funds is revaluing unlisted assets and properties.
Yeah.
That's a whole show for someone else, because that's going to get pretty messy when you look at these sky-high commercial property valuations as well. And I guess with asset protection, maybe savers, investors and families might start to go more conservative. But you've got to look on the flip side where everything's costing more, and to get ahead, you've got to take risks, and you can remove all the costs out of your family. I mean, you can pull the kids out of private schools, but again, that goes with prestige and shame. As I said, the best chance to sell your car is already gone. So I just don't think this generation has seen harsh economic times. And I remember exactly where I was when I was worried that interest rates and mortgages were about to hit 10%, and that was just before the GFC. So, markets can change quite quickly, but you have to go back to the recession we had to have for many to have experienced harsh economic times, and they're coming. We're in them. So, it's a case of how do I grow my portfolio? How do I protect what I have? And more importantly, guys, how do we remain solvent as a family? How do we get the hell through this?
Absolutely. Well, it needs to be, I think, a grown-up conversation, right? And what I encourage people to do, I don't give financial advice, but, there are some fundamental things about, well, do you understand where your money's coming in? And where is it going out? So have you got a sense of cash flow? Only half the households that I survey have any real sense of where they are. So, how much money is going out. They sort of assume it's like a magic pudding, right? There's always enough money so I can go on spending. Well, actually, currently that might not be true. So getting to understand the cash flow and getting to understand where things are is, I think, step one. A lot of people are really surprised when they do that and horrified, because then they review exactly what they've been spending their hard-earned cash on, right? And how much money is it coming in versus going out. The second, of course, is that you've got to make some tough decisions. And I always say to people when I chat with them, sometimes making decisions sooner rather than later is good. So don't just say she'll be right and put your head on the ground and hope it'll all work out. Because often with these sorts of situations, you can survive for a length of time, but the longer you actually go through this sort of painful experience, the less agility and flexibility you have at the end of it. So sometimes taking decisions early rather than later is more sense. And the third thing is that there is no silver bullet here. There's no magic, click the fingers and it'll be fixed, right? This is too long and complicated and difficult. So, again, it is a very complex environment, but I just wonder whether people are actually intellectually and and perhaps even morally capable of actually doing some of the hard decisions they need to take.
I think that there'll be a huge struggle in that regard. It's, I know when my mortgage cliff is in November 26, I managed to lock in a 5-year fixed, and I'm already looking at ways to certainly mitigate that, where I can maybe look at strengthening my situation. And that's, I don't think the odds of having interest rates anywhere near 2.64% on that date. Who knows? Who knows what's going to happen? I'm going to budget for my repayments to double by then. So I'm already looking at the sunk costs I've spent on this house, what I need to spend, making sure that the cars are looked after. That's it. And to make sure that we've got a comfortable way of living. And already, I don't want to wish my life away, but that's what you're doing. But I'm preparing for November 26th when I'll get that wonderful letter from my lender saying, it's over. The honeymoon is over.
Yeah. Well, you did well with that duration of fixed rates. A lot of people, of course, didn't go as long. I remember making a show 18 months ago when mortgage rates the fixed rates were below 2%. And I remember saying at the time, those rates are astoundingly low. You will never see the likes again in your life. Great opportunity if you can log it in. Proved, I think, to be the case. I don't think we're going to see very, very low rates again. I just don't think it's going to. I think central banks learned a lesson when they actually took rates too low and did all of the quantitative easing. I don't think they'll be as aggressive again, but I could be wrong. But that's my sort of philosophy. Now, Cookie Boy asked a quite interesting question, and we might just you will know 007. Unfortunately, he died a few months ago, but he and I had a number of conversations. He was a Brit. He was very much into the financial system. And Roger Brown basically said, hey, you got to understand that this is serious what's going on. Property prices will fall. Interest rates are going to go up. People will lose their shirts. The financial system is significant risk. And I have to say, he's unfortunately left us, but his legacy is such a penetrating analysis of what was going to happen that it is remarkably precedent. And I wonder whether you got a sense of, how far will he be right? Because he's been spot on so far.
I actually had a look at his Twitter page a few days ago, and obviously you can see when he was in no position to tweet, but some of his tweets were, at the time, seemed crazy. He was saying 5-year fixed rates were going to hit 6%. Unbelievable. But that guy, Roger, had the courage to just come out and say it. He had no fear of what he was going to cop from other people on Twitter. And he just told the truth with a deep education. And I think it was sad that he has passed away. That tweet was quite emotional when he said he's only got a couple of weeks to live, and he finally succumbed to bowel cancer, I think he died of. Yep. But who out there has the courage to say what he did? No one. And when we're in a bubble and people are jumping over each other to get dopamine, to get on a TV show, to pay well over the top, do we ever think of the downside? But I doubt those that have paid the top would be reading his tweets. But it's actually quite a concern that he was talking about median prices in the 5s, 6s and 7s in Sydney, which is truly horrifying. But who knows? Who knows, guys? But, he was certainly a rare commodity, not afraid to say it exactly how it is. And he copped it. But, his legacy will certainly live on. And it certainly makes me think about, well, how far do I go with my truth as well? And let's not. Well, you can't really polish a turd, can you? So it is what it is. As I said, I dropped my first F-bomb on this program because I don't think any other word gives it justice to the economic mess we're in.
No, somehow stuffed doesn't quite.
No,
it doesn't quite make it, does it?
No.
No.
I mean, the F word, in all honesty, is the most versatile word there is. I went to a Post Malone concert a few weeks ago. I said to my son Lachlan, I said, if this guy could just cut down the Fs, I'd enjoy it. But you have to use it strategically. You have to curse where it's needed, and I think this situation is certainly needed.
Absolutely. Well, Tony, we've run this for about an hour, and I really wanted to have an opportunity to get from you your latest thoughts and insights as I begin to transition my shows. So just to explain to everybody that I will be ceasing my live streams very shortly. There'll be one more tomorrow, which will be a detailed walkthrough of the latest mortgage stress stuff. I will be making the old recorded show for the next few days as I take the studio apart, but I won't be able to do the sort of the live stream like I've been doing it. But what I hope is that once I've set myself up in the UK, with the time difference, it'll be morning in the UK, but evening here. I very much hope we can continue these dialogues because I, for one, have really valued your insights and perspectives. And sometimes it was important because, frankly, I felt I was swimming uphill. So,
Yeah.
But you've always had a strong sense of, no, this is actually serious and these are important issues. So I really appreciate your insights and your philosophical positioning around some of this. So as we sort of come to the end of the show, what would be the sort of the couple of fundamental messages you'd want to leave with the audience?
Well, I take the view that this audience are educated, that this audience didn't buy a property at the top with leverage they can't afford. I guess the key takeaway is to stay humble, and because markets can certainly teach you some valuable lessons. And this is going to affect everyone from the average battler to, the likes of Mike Cannon-Brookes that can afford a $100 million house. And it's going to affect everyone. And the richest are going to see the impact of it. I just think you need to stay safe. You need to take control of your mental health because I think that's going to be an even bigger issue. Stay as healthy as you can, stay above it. And at least know where to drive at night. There's certainly going to be some dodgy areas, but this is a really sad event that's unfolding. Some might say that I'm over-dramatising it, but, I've had 8 years as a cop in some now blue-chip suburbs trying to catch free VB bottles, Martin. So I think I like to look at the human aspect of what's happening behind the charts. I think you can give charts to the nth degree. I think an hour is a perfect time for this chat. I don't think there's anything more I can say, really. I'm spent.
Yeah, no, thank you. Well, I think that we've covered off the main things. I did put a poll up, which we just might have a quick look at, because what I asked was, let me have a look, get this up. Whoops. I asked, will Australia avoid a recession? And basically we've got 15% in the poll saying yes, we'll avoid a recession, 67% no, we won't avoid a recession. I defined recession as a GDP reversal, not GDP per capita, and 17% said not sure, 18% said not sure. So interesting, quite decisive that people think that things are actually going to go from an economic perspective downhill from here. I'm going to end the poll now. And I guess what I would say in closing the conversation is you've got to take responsibility for your own financial position, right? You can't just say, well, the YouTube guy said do this or whatever that, or CoreLogic said everything's going to be fine. It's really, really important to take some accountability and responsibility, but also to preempt perhaps some of those things that are yet to come. And the hopium that's still out there is something which I'm very concerned about, because I think a lot of people are still being fooled by the mainstream media to an extent, and some of the economists who, of course, are talking their own book rather than actually giving an objective and independent view of what's going on. So, be a bit cautious, be a bit careful. And the truth of the matter is that the next few months are going to be pretty uncomfortable for most people, I think. And, it's just going to be the way it is. And I just want to acknowledge also Cookie Boy. Thank you very much. Cookie has made a contribution of $100 to asbestos awareness. Thanks for the little initiative there, Cookie. When you actually said on retweets you'd actually put something there, so that's really appreciated. And there will be a show coming just on asbestos awareness. Jill's final paper was published last week, and I'm going to make a show on that before I finish off, which sort of rounds out her initiative with regards to raising awareness of asbestos, which is another thing which we might talk about on another occasion on the channel here. So, Tony, I want to say thank you so much for spending some time here tonight. Really appreciated your perspectives. And we'll look forward to continuing the dialogue when I'm ensconced in the UK, eh?
Enjoy, and thanks again to this great community. I certainly have a blast doing these shows, and hopefully can continue.
Thank you, and I love the fish. I must just say, the fish behind you there, it's a great set you've got. Well done.
It's real. It's a real fish tank. So there you go. My partner set it up. I wouldn't have a clue what's swimming behind me, but anyway,
it's not real. Hopefully, it's not a shark. Thank you, Tony. Take care. Right. Have a great evening, and we'll be in touch soon. Take care. Bye bye.
Thanks, Martin. All the best.
So there you go, folks. Nice little ending there from Tony. And just to remind you that if you'd like to come back tomorrow night, I'll be on. I've called the show The Final Fling for now. I'll talk a bit about mortgage stress. I'll take some other questions more broadly on what's going on, and tell you a little bit more about my plans and other things. But mark your diary for that. And just to reiterate, my plan is to temporarily reduce the volume of shows and disappear for a little while, but then I will be back. I'm still planning to do Australian content. I'm still planning to do Australian shows, and I'm still planning to get some of the guests to come back on, and the time frame will be similar to what we're doing now. So 8 p.m. Sydney time. I'll just be over there in the UK in the morning, but I'm not deserting anybody. And I want to say thank you all for spending some time tonight, and wish you a very great evening. And for those coming back tomorrow, we'll see you tomorrow. Otherwise, if you don't come back tomorrow, keep watching the channel, keep following, and eventually I will pop up from the other side of the world, and we'll talk some more about property and finance and all those related things. So this is Martin North from Digital Finance Analytics, signing off, and we'll see you tomorrow. Good night.